Welcome to Talk Tickers.
Glad to be here for this one.
Yeah, I'm really excited about this. You know, there's this old saying on Wall Street, and it really serves as kind of the perfect North Star for the deep dive you are taking with us today.
Oh, I think I know the one you mean.
Yeah, it's earnings are an opinion, cash is a fact.
That is spot on.
Right. Because whenever management teams make a choice to achieve some, desired financial result, they always leave discernible evidence behind. It's exactly like looking at tracks in the snow.
I love that analogy. Tracks in the snow.
Yeah, because if you know how to read the spacing, the depth, the direction of those tracks, you can tell exactly where a company is heading. And perhaps more importantly, you can tell exactly what they're running from.
That is the perfect way to frame it, really, because it shatters this whole illusion that financial statements are just, objective mathematical readouts of reality.
Really, like they just pop out of a calculator.
Exactly. They absolutely are not. Financial statements are the product of hundreds, sometimes literally thousands, of distinct choices, estimates, and judgments. And those are made by human beings who are, frankly, under immense pressure.
Huge pressure. So today, you are exploring a fundamental concept in financial analysis with us. We're looking at the spectrum of financial reporting quality.
Right.
Specifically, we're going to dissect the crucial differences between conservative and aggressive accounting. And we're going to equip you with the exact forensic tools you need to spot manipulation.
Which is so critical.
It is. And here's why you, as a listener, should care about this right now. Whether you are an equity analyst trying to build out a discounted cash flow valuation model, or maybe you're a candidate grinding through the grueling CFA exams, taking reported numbers at face value is a guaranteed recipe for disaster.
Oh, it's a total disaster. You just can't do it.
You must understand how to adjust financial statements for comparability. And you have to be able to assess the true sustainability of a company's earnings. Because if you cannot spot the tracks in the snow, your entire valuation is basically built on sand. You're flying blind.
Exactly. You're completely blind. So let us start by defining the boundaries of this spectrum, right? Because financial reporting quality spans a very, very wide continuum.
Right. It's not just black and white.
No, not at all. At the absolute highest end of the spectrum, reporting is relevant, correct, complete, and completely unbiased.
That's your perfection.
Right. It reflects the pure economic reality of the business at that exact moment in time. But then at the absolute lowest end, it is pure fabrication.
Just straight up lies.
Yeah. We are talking fictitious sales, forged bank statements, outright fraud, stuff that sends you to prison.
Right.
But the vast majority of publicly traded companies, they live in this massive gray area in between those two extremes. And that gray area is exactly where management exercises its discretion.
Right. And within that gray area, we generally talk about two main poles, right? Conservative accounting and aggressive accounting.
Yes.
Let me give you an analogy to anchor how these two approaches function, because I think this helps visualize it.
Okay, let's hear it.
So conservative accounting is like packing a massive golf umbrella for a weekend trip when the forecast says there's only like a 10% chance of a light drizzle.
Over-preparing.
Exactly.
Yeah.
Now, aggressive accounting is leaving the umbrella at home during a Category 4 hurricane because you assume you're fast enough to just sprint between the raindrops.
Wow, yeah.
Right. One approach builds a massive margin of safety into the financial statements. The other relies entirely on highly optimistic, best-case scenario assumptions.
I love that analogy because it perfectly illustrates the mindset behind the math. To put your umbrella analogy into technical accounting terms, conservative accounting recognizes expenses and liabilities as soon as possible.
Right away.
Right. While deliberately delaying the recognition of revenues and assets until there is an absolute high degree of certainty.
So they wait on the good news, but take the bad news immediately.
Exactly. Because of this, conservative accounting inherently understates current performance. Aggressive accounting does the exact opposite.
Sprinting between the raindrops.
Yeah. It artificially inflates current performance by pulling forward revenues into the present day and pushing current expenses far out into future periods.
Now, just to establish the scope of what we are doing on this deep dive today, we are not going to sit here and read you textbook formulas, right? or teach you basic bookkeeping.
No, nobody wants that.
No, we're going to deconstruct the actual mechanical plumbing of biased revenue and expense recognition. We're going to look at the psychological motivations behind these management choices.
Which is fascinating.
It really is. And we will walk through the specific quantitative ratios and cultural warning signs you use to detect them. We are basically going to treat this like the anatomy of a fraud.
And that is the right approach because the CFA curriculum emphasizes this topic so heavily for one simple reason, right? High-quality reporting is the only way to accurately reflect economic reality.
The actual truth of the business.
Right. Aggressive accounting might technically stay within the legal boundaries of acceptable standard practice, but it fundamentally misrepresents the sustainability of a company's performance.
Makes them look healthier than they are.
Exactly. As an analyst, you have to know how to strip away the creative accounting to find the true baseline. If you are modeling out a terminal value for a company based on a manipulated baseline, your entire valuation is garbage.
Just totally useless.
Completely.
So let us unpack the theoretical foundation here, because there is actually a built-in conflict in the rules themselves that has always, well, it's always fascinated me.
The tension between neutrality and conservatism?
Yes. The conceptual framework of accounting. The ideal utopia that standards strive for, advocates for pure neutrality. The goal is supposed to be a completely unbiased depiction of financial information.
Right, just the facts.
But actual accounting standards often mandate conservatism. For example, under US GAAP, you generally have to expense research and development costs immediately rather than capitalizing them as an asset.
Which is a huge hit to earnings.
It is. Or you have to value your inventory at the lower of its historical cost,
right,
or its net realizable value.
There is a deep structural irony there. Conservatism inherently introduces a downward bias in the current period, which directly conflicts with that utopian goal of pure neutrality.
I have to push back on the logic of the rule makers here, though, because why mandate a downward bias?
It's a fair question.
I mean, if the goal is an accurate picture of the business, why force companies to artificially make themselves look worse? It seems like lenders and bondholders essentially hijack the accounting rulebook to protect themselves, while equity investors are just left trying to guess the real upside.
That is a very astute observation, and you just nailed the historical origin of the bias right there. Yeah. The system mandates this downward bias primarily to protect less informed parties, specifically lenders and creditors, who bear asymmetric risk.
Because they only get their interest payments. They don't get the upside.
Exactly. If a bank is loaning a company $50 million based on the collateral of its warehouse assets, the bank does not care about the optimistic blue sky valuation of that inventory. They want to know the absolute worst case scenario liquidation value.
Right. If everything goes to zero, what can we sell this for?
Right. And conservatism also massively reduces litigation risks.
Oh, that makes sense.
Yeah, think about it. Shareholders very rarely sue a management team for quietly understating good news.
Right, because if they beat expectations later, everyone's happy.
Exactly. But if management overstates financial health and the stock collapses, the class action lawsuits fly instantly. So the rules evolve to prevent companies from overstating their hand.
But that tension between what the conservative rules dictate and what a growth-hungry management team actually wants to report, I mean, that creates a massive playground for manipulation.
Oh, absolutely. It's a constant battle.
So to understand how we got to the modern landscape of earnings manipulation, we really have to trace the evolution of what former SEC Chairman Arthur Levitt famously called accounting hocus pocus.
Yes, the famous 1998 speech.
Exactly. He called out the numbers game, identifying these classic illusions that are still heavily tested on the exams and heavily utilized in the market today. Let's walk through them, starting with the psychological pressure cooker that creates them.
The pressure cooker is the key to all of this. Fraud and aggressive accounting are rarely born out of pure malice, right? They are born out of pressure.
The need to perform.
Right. It is the pressure to meet relentless Wall Street consensus estimates, the pressure to trigger executive bonus thresholds, or even the pressure to avoid violating debt covenants.
We would bankrupt the company.
Exactly. When a CEO realizes they're going to miss earnings by a penny, the pressure to find that penny becomes overwhelming. And that leads to the first illusion Levitt highlighted, materiality abuses.
Materiality abuses. Okay, this happens when management intentionally records small, mathematically immaterial errors to just barely hit those consensus estimates.
Right.
Let's say Wall Street expected $1 per share in earnings, and the true operations only generated 99 cents. Management might find a tiny, questionable adjustment, maybe tweaking the salvage value of a few trucks to find that one extra penny.
Just enough to cross the finish line.
Right. And when the auditors catch it, management's defense is always, come on, it's just a penny. Out of hundreds of millions of dollars in revenue, this is quantitatively immaterial.
But qualitatively, it changes an earnings miss into an earnings beat.
Which is a huge difference.
It is. In the modern stock market, missing by a penny can wipe out billions of dollars in market capitalization. Therefore, that tiny adjustment is highly material to the stock price.
We actually saw this exact scenario play out in a major SEC enforcement action against Rollins, the giant pest control company.
Oh, the Rollins case.
Yeah. The SEC found that the CFO was making totally unsupported manual reductions to their accounting reserves in amounts just sufficient to allow the company to round up their reported earnings per share to the next penny.
The mechanics of the Rollins case are fascinating because they literally had internal meetings about how to manage unexpectedly low income.
They just sat around a table and figured it out.
Basically, yeah. They would look at the preliminary numbers, realize they were a fraction of a cent short of the consensus, and then magically find the exact fractional amount needed to beat the street by artificially releasing reserves into the income statement.
Which perfectly segues into Levitt's next illusion, which is exactly what Rollins was abusing, cookie jar reserves.
Yes.
I love the name of this one, but how do you actually hide the cookies? What is the mechanical plumbing of this trick?
Let's visualize the mechanics. Imagine a company that manufactures heavy farm equipment, okay? During an incredibly strong economic boom, their sales are through the roof. They are crushing earnings expectations. Management looks at this and thinks, we are having too good of a year. The market expects us to grow from this new sky-high baseline next year, and we just can't sustain it.
Right, because booms don't last forever.
Exactly. So they decide to snatch some of this profit away for a rainy day.
But how? They can't just hide cash in a mattress.
No, they do it through estimates. When you sell farm equipment, you have to estimate future warranty costs. Let's say historically, warranty repairs cost 2% of sales.
Standard wear and tear.
Right. But because they're having a record year, management suddenly decides to be hyper-conservative. They tell the auditors, you know what, we think the new tractor models might have transmission issues. We need to increase our warranty reserve assumption to 5% of sales.
Ah, I see. So by arbitrarily bumping that estimate up to 5%, they are forcing a massive artificial expense through the income statement today.
Exactly. Because times are so good, the market doesn't really punish them for the slightly lower earnings. They still beat expectations anyway.
It had room to spare.
Right. But what they've mathematically done is create a bloated liability on their balance sheet. That bloated liability is the cookie jar.
Okay, so the cookies are hidden.
Right. Now, fast forward 2 years, the economy enters a recession, tractor sales plummet, the company is about to miss Wall Street estimates. What does management do?
They reach into the jar.
Precisely. They suddenly announce, great news, those tractor transmissions were actually incredibly reliable. We no longer need that 5% warranty reserve. We are adjusting it back down to 2%.
Wow.
And when you reduce a liability reserve, that reduction flows straight through the income statement as a sudden, massive boost to operating profit.
So they magically manufacture an earnings beat during a terrible quarter, entirely smoothing out their income.
Exactly. And to an analyst relying purely on the bottom line, it looks like this tractor company has the most resilient, stable business model in the world, completely immune to recessions.
But it is an illusion.
Total illusion. You are looking at accounting volatility, not economic stability.
Now, what about the opposite scenario? What happens when a company is already having a catastrophic year? That brings us to Levitt's third trick, the big bath.
The big bath. This is often deployed when a new CEO takes over or when a company has already pre-announced terrible earnings.
Like everyone already knows it's a bad quarter.
Right. The mechanics involve accelerating every conceivable expense, massive asset write-downs, and future restructuring charges into a single horrific loss-making quarter.
So they just dump everything in.
Yes. Management's logic is cynical but effective. The market is already punishing the stock, so you might as well take the kitchen sink approach and clear the decks entirely.
Wait, if the goal of a CEO is to show growth, why would a brand new CEO purposefully make their first quarter look like an absolute unmitigated disaster?
Because it resets the baseline.
Oh, I see.
By taking a massive hit to earnings today, they artificially lower the bar for all future periods. Think about it. If I write down the value of all my factories to zero today, I take a massive loss this year. But next year, I have zero depreciation expense.
Because the asset is already written down to zero.
Exactly. My margins will look spectacular next year. The new CEO gets to blame the massive loss on the, quote, poor decisions of the previous administration, and then claims credit for the miraculous turnaround in profitability the following year.
It is taking all the pain at once so you never have to feel it again. That's wild. Now, these first three tricks, materiality, cookie jars, and big baths, deal heavily with estimates and expenses. But the ultimate crown jewel of accounting manipulation, and the fourth illusion Levitt highlighted, is premature revenue recognition.
Yes, the classic.
This is booking sales before the earnings process is truly complete.
And this brings us to a vital distinction you must understand as an analyst: the line between aggressive accounting and creative or fraudulent accounting.
The gray area versus prison time.
Exactly. Aggressive accounting exploits the gray areas. It pushes the boundaries of GAAP or IFRS to the absolute limit, but it retains an underlying factual basis.
A real transaction did occur.
Right. Management is just interpreting the timing very liberally. Creative accounting, on the other hand, involves outright fabrication. Recording a sale to a customer that literally does not exist is not aggressive. It is fraud.
Right. Crossing that line takes you from an SEC fine to a criminal indictment. So, let us move into practical application. How do practitioners actually spot these maneuvers in the wild?
That's the million-dollar question.
It is. The workflow for an analyst relies on targeting the two primary engines of manipulation: revenue and expenses. Let's look at revenue shenanigans first, starting with a classic textbook scenario to understand the plumbing. We will call it the Capital Motors scenario.
Let's visualize this. Imagine Capital Motors, a car dealership, on December 31st. It's the last day of their fiscal year.
Okay, high pressure to close the year strong.
Exactly. A customer comes in, signs all the paperwork for a $50,000 luxury car, but leaves the car on the lot to be detailed. And they hold the actual payment check until January 2nd while they finalize their bank financing.
Right.
If the dealer books that $50,000 sale on December 31st, that is highly aggressive accounting.
And why is that a problem? I mean, the customer signed the contract, they committed.
Because the core principle of revenue recognition is that the risk and reward of ownership must have fully transferred to the buyer, and the revenue must be earned and realizable.
Oh, so the transfer of risk is key.
Exactly. In this scenario, the customer hasn't taken delivery, and the financing isn't fully secured. What if a massive hailstorm destroys the dealership lot on January 1st?
Capital Motors still bears the risk of loss.
Right. The customer isn't going to pay for a hail-damaged car. Booking that revenue makes the current year look fantastic, but it violates the economic reality that the transaction isn't truly finalized.
Okay, that makes sense for a single car. But let us scale this up to a real-world, multi-million-dollar example of pulling forward sales that made major headlines.
You're thinking of the SEC enforcement case against Under Armour.
Yes, the Under Armour case.
Yeah.
This case is a masterclass in how aggressive revenue recognition destroys a company from the inside out.
It perfectly illustrates the slippery slope. So in late 2015, Under Armour was facing an unexpectedly warm winter in North America.
And they sell cold weather gear.
Right. This was crushing their sales of high-margin, cold-weather apparel. They were on the verge of missing Wall Street revenue growth targets for the first time in over 6 years.
The streak was going to end.
And management couldn't accept that. To close the gap, management instructed their sales teams to contact wholesale customers like major sporting goods retailers and ask them to accept shipments in the current quarter that were originally scheduled for the next quarter.
Now, wait a minute. Let me play devil's advocate and push back on this.
Go ahead.
If the sporting goods retailer actually agreed to take the goods early and Under Armour physically put the hoodies on a truck and shipped them, hasn't the risk transferred?
It has.
So if aggressive accounting simply shifts the timing of a perfectly legitimate sale by a few weeks, doesn't it all balance out eventually? Why is it such a massive red flag if the company's products are genuinely being sold?
That is the exact defense management teams always use when they are caught. We just shipped it early. But here is why it is incredibly dangerous. The reckoning period.
The reckoning period.
Yes. Aggressive accounting borrows from the future. It is a loan that must be repaid. When Under Armour pulled those massive sales into Q4 to save their streak, they completely cannibalized their Q1 revenue. So when Q1 rolls around, they start in a massive hole.
Oh, because the retailers already have enough inventory. They aren't going to order more.
Exactly. They're fully stocked. So to make the Q1 numbers, Under Armour has to pull even more sales forward from Q2. And then Q2 has to steal from Q3. It creates an unsustainable, accelerating treadmill. Eventually, you run out of future revenues to pull forward. You cannot force a retailer to take 3 years of inventory today.
Right.
When the music finally stops, the growth narrative collapses instantly, the warehouses are stuffed with obsolete product, and the company faces massive write-downs and a destroyed stock price. The SEC didn't necessarily penalize the physical act of shipping early. They penalized the failure to disclose to investors that the revenue growth was manufactured, unnatural, and completely unsustainable.
Describing the pull-forward revenue internally as bad, unnatural, and unhealthy. Those are the exact words the SEC found when they subpoenaed their internal emails.
Yeah, they knew exactly what they were doing.
It was an organic demand. It was a parlor trick. And that perfectly segues into the other side of the income statement, the manipulation of expenses, specifically capitalizing expenses versus expensing them immediately.
This is where we look at the balance sheet as a hiding place for income statement pain.
A hiding place.
Right. When a company incurs a cost, the accounting rules generally give them two choices based on the nature of the cost. They can expense it immediately, which hits the income statement and lowers current net income.
Painful route.
Yes. Or, if the cost provides future economic benefit, they can capitalize it.
Meaning they record it as an asset on the balance sheet and slowly amortize or depreciate that cost through the income statement over several years.
Precisely. And capitalizing an expense is an incredibly powerful tool for inflating current period earnings.
Let me offer an analogy to explain the sheer mechanics of why this works so well.
Let's hear it.
Capitalizing an immediate expense is like taking your weekly grocery bill and financing it into a 30-year mortgage.
That is terrifying.
Right, sure, your checking account looks absolutely amazing this month because you only paid a fraction of a cent for your apples. But you are creating a massive, invisible burden of debt on your future self. If a company spends $10 million on routine, everyday marketing, and they expense it properly, their profit drops by $10 million. But if they somehow justify capitalizing it as a long-term brand-building asset and amortize it over 10 years, their profit only drops by $1 million this year. They just magically created $9 million of pre-tax profit out of thin air.
That grocery mortgage analogy is terrifyingly accurate, and the most famous catastrophic example of this exact mechanism in financial history is WorldCom.
Oh, WorldCom. Huge.
Yeah. WorldCom did not invent a complex derivative scheme like Enron. Their fraud was breathtakingly simple and brazen. They took billions of dollars in routine line costs, which were the mundane fees they paid to other telecom networks to route their phone calls, and simply move them from the income statement to the balance sheet.
So how does a multi-billion-dollar telecom giant just pretend its everyday phone bills are long-term assets? I mean, how did the auditors miss that?
It started again with pressure. The dot-com bubble was busting, telecom capacity was overbuilt, and WorldCom's revenue was stalling.
So they were desperate.
Extremely desperate. CEO Bernie Ebbers and CFO Scott Sullivan needed to maintain the illusion of massive EBITDA margins to support their debt load. So they instructed the accounting department to take these routine line expenses and categorize them under vague capitalized asset accounts like prepaid capacity.
They just changed the label on the folder.
Literally. The journal entry should have been a debit to line expense and a credit to cash. Instead, they debited property, plant, and equipment.
For phone bills.
Yes. And Arthur Andersen, their auditors, failed to push back because they didn't rigorously test these massive additions to the fixed asset accounts. It was eventually uncovered by Cynthia Cooper, the head of internal audit, who worked late at night to trace the journal entries backward and realized billions in supposed assets were just phone bills.
That is insane.
Yeah.
Now, WorldCom was outright fraud, but let's look at a gray area where capitalization is legal but heavily manipulated today. Software development costs.
Oh, this is incredibly prevalent in the tech sector right now.
Right. The rules dictate that early-stage research and development, when you were just brainstorming and testing code, must be expensed immediately. But once a software product reaches a milestone called technological feasibility, the costs incurred from that point forward until the product is released can be capitalized as an asset.
And the gray area there hinges entirely on the definition of technological feasibility. Management has enormous subjective discretion in deciding exactly when that threshold is crossed.
They can just declare it whenever they want.
Almost. If a tech company is facing a tough quarter and earnings are coming in light, they might suddenly decide that a massive new software project achieved feasibility much earlier in the development cycle than usual.
Which allows them to take the salaries of hundreds of software developers, pull them off the income statement where they were hurting profits, and dump them onto the balance sheet as an asset.
Exactly. And as an analyst, how do you spot that? You cannot rely on the income statement. You have to look at the statement of cash flows.
Because the cash doesn't lie.
Right. The cash paid to those developers is still physically going out the door to pay their mortgages. It will show up in the investing section of the cash flow statement as a cash outflow for capitalized software, rather than appearing in the operating section. This is why you can never just look at the income statement in isolation.
Furthermore, you have to look at the capitalization rate compared to the company's peers. If company A is aggressively capitalizing 60% of its total R&D spend, while the rest of the software industry is only capitalizing 20%, Company A is making a highly aggressive accounting choice.
They stand out like a sore thumb.
Yeah. Their current earnings are heavily inflated relative to their competitors, and their future periods will be burdened by the heavy amortization of all those capitalized developer salaries.
It is the umbrella analogy all over again. They are assuming it will never rain. They are assuming this new software will launch flawlessly, sell millions of copies, and generate revenue for years to cover those capitalized costs. But if the software flops, the asset is worthless, and they were looking at a massive, sudden impairment charge that wipes out equity.
So we've talked about the theory and the historical frauds. Let's get into the forensic toolkit.
Yes, the good stuff.
These are the quantitative metrics and thresholds analysts use to scrape away the hocus pocus. The first major indicator is Days Sales Outstanding, or DSO.
DSO is a critical metric. Instead of memorizing the textbook formula, I want you to visualize what DSO actually represents. It's a timer.
A timer?
Yeah. It starts ticking the exact second a company books a sale and recognizes revenue, and it stops the second the actual cash from that sale hits the company's bank account.
So it measures how long it takes a company to collect its cash.
Exactly. If you calculate this ratio over several quarters and see it steadily rising, say, the timer usually takes 45 days, but suddenly it stretches to 65 days, and then 80 days it means reported revenue is growing, but the cash isn't following.
The cash is lagging.
Right. Why does that happen? Usually, it means management is desperately begging customers to buy product by offering them overly lenient credit terms. They are telling customers, please buy this today so we can book the revenue and we will let you wait 120 days to actually pay us.
Or worse, they are engaging in the channel stuffing we saw with Under Armour. They are literally forcing excess inventory onto their distributors at the end of the quarter, knowing the distributor won't pay for it anytime soon and might even demand the right to return it.
Which means it wasn't a real sale to begin with.
Exactly. A rising DSO is a blaring red siren that the underlying quality of the revenue is degrading rapidly.
The second tool in the kit, and arguably the most vital ratio we look at in all of financial forensics, is the relationship between cash flow from operations, or CFO, and net income.
The ultimate lie detector.
It really is. You simply divide CFO by net income. If net income is rising quarter after quarter, looking like a beautiful upward staircase, but CFO is flat or declining, resulting in a ratio that is consistently dropping below 1.0, you have a massive red flag.
Let's slow down and really explain the mechanics of why that ratio is the ultimate lie detector.
Sure.
Net income, the bottom line on the income statement, includes all of those aggressive accruals we've been talking about. It includes the pulled forward revenue where the cash hasn't arrived. It excludes the capitalized expenses where the cash has already gone out the door.
All the accounting fiction.
Right. Cash flow from operations acts as a brutal truth serum. It strips all of that accounting fiction away, it adds back the non-cash depreciation, and it subtracts the massive buildup in accounts receivable.
Management can legally manufacture net income through optimistic assumptions and spreadsheet tweaks, but they cannot manufacture the physical cash clearing their bank account. If the CFO to net income ratio is well below 1.0, the earnings growth is a paper illusion. It is an accrual mirage.
And the third critical metric focuses squarely on the balance sheet. Inventory turnover. This is calculated as the cost of sales divided by average inventory.
Think of inventory turnover as the velocity of the warehouse. A declining inventory turnover ratio means goods are sitting on the shelves longer and longer before being sold.
They aren't moving.
Right. If you combine a declining turnover ratio with an inventory balance that is drastically outpacing sales growth, you are likely looking at a warehouse full of dead, obsolete stock.
And why is that an accounting problem?
Because under the rules of conservatism, management is supposed to write down the value of obsolete inventory immediately. But they refuse to do it because taking that impairment charge would crush their precious net income. They just let the dead stock pile up, delaying the inevitable reckoning.
Now, beyond the cold, hard numbers, there are cultural warning signs that qualitative analysts must weigh. The tone at the top of the organization dictates the quality of the numbers at the bottom.
Always. Culture is everything.
One massive red flag is a relentless M&A orientation. A company that uses constant acquisitions to fuel a narrative of growth at any cost.
When we talk about M&A as a smokescreen, Tyco International in the late 90s and early 2000s under CEO Dennis Kozlowski is the absolute poster child.
Oh, Tyco, that was wild.
Tyco acquired over 700 companies in 6 years.
700.
700. When a company is doing that many deals, integrating that many different accounting systems simultaneously, it is nearly impossible for external auditors, let alone retail analysts, to track the organic growth of the base business.
It creates intentional chaos.
Precisely. And Tyco abused a specific technique called spring loading in acquisition accounting. When they bought a company, they would intentionally understate the value of the acquired company's assets on the opening balance sheet and overstate their assumed liabilities.
Wait, why would Tyco want the company they just spent millions buying to look completely worthless on paper?
Because of what happens the day after the acquisition closes. By valuing the assets at artificially low prices, Tyco drastically lowered their future depreciation expenses.
Oh, wow.
And by over-accruing liabilities, creating massive cookie jars upon acquisition, they could magically reverse those liabilities into the income statement in the following quarters. They bought earnings. They used the chaos of constant integration to hide massive operational flaws in their core industrial businesses.
Which brings us perfectly into the exam context and how these forensic concepts connect across the broader CFA curriculum. This isn't just an isolated financial reporting and analysis topic to memorize.
Not at all. It touches everything.
It directly bridges into equity valuation. The entire premise of a discounted cash flow model, or a PE multiple valuation, relies on the foundational assumption that the baseline earnings and cash flows you are projecting into the future are real and sustainable. If you feed manipulated, aggressive earnings into a DCF, your intrinsic value output is completely fictional.
Garbage in, garbage out. And the exams love to test your ability to spot this baseline manipulation, especially by testing the subtle, annoying nuances between International Financial Reporting Standards, or IFRS, and US GAAP.
Oh, the standards differences, they love those.
They really do. Let's look at inventory write-downs. Say a company writes down its inventory because the market price collapsed. A year later, the market recovers miraculously. Under IFRS, the company is allowed to reverse that write-down, up to the original cost. But under US GAAP, reversals of inventory write-downs are strictly prohibited.
Once you write it down under US GAAP, that establishes a new, permanently lower cost basis. You cannot write it back up.
Right.
So what is the practical implication for an analyst? US GAAP forces a much more conservative long-term balance sheet in this specific instance. If you are a global sector analyst comparing a European competitor using IFRS against a US competitor using GAAP, you cannot just look at their profit margins side by side. You have to manually adjust for this difference to make an apples-to-apples comparison.
Here is another classic exam scenario, and honestly, one of the most fascinating intersections of accounting rules and economic reality: LIFO versus FIFO inventory costing.
Yes, LIFO and FIFO.
In an inflationary environment where the cost of raw materials is steadily rising over time, a US GAAP company using LIFO, or last in, first out, is matching their most recent highest costs against their current revenue. That is considered conservative. It lowers current net income, and crucially, it saves the company massive amounts of cash on taxes.
Right. But honestly, LIFO has always seemed like a giant state-sponsored scam to avoid paying taxes. Why does US GAAP even allow companies to pretend they're selling their newest inventory first? Physically, that makes no sense. If you run a grocery store, you don't push the oldest milk to the back and sell the fresh milk first. It would all spoil.
You are absolutely right that it rarely matches the physical flow of goods. LIFO is essentially a tax loophole that became an accounting standard. But here is where the manipulation happens and what the exam will rigorously test you on: LIFO liquidation.
Let's walk through the mechanics of a LIFO liquidation slowly. because this is where the timeline really matters.
Imagine a company that manufactures steel, and they have been using LIFO since 1990. Under LIFO, the oldest steel they bought in 1990 is just sitting on their balance sheet at 1990 prices, let's say $50 a ton. Every year, they buy new steel at higher prices and immediately expense it. Now it is 2026. The current cost to produce a ton of steel is $500.
Okay, so their normal operations require matching current $500 costs against current revenues.
Exactly. But let's say the company is having a terrible quarter. They're going to miss earnings. Management needs a miracle. How do they find one? They intentionally stop buying or producing new steel. They let their warehouse physically deplete. Because they have no new 2026 inventory coming in, the LIFO accounting system forces them to dip into those ancient historical layers to calculate their cost of goods sold.
Oh, wow. So suddenly they're selling steel at 2026 market prices, but they're expensing it at that 1990 cost of $50 a ton.
Precisely. That artificial gap between current revenue and ancient costs causes their cost of goods sold to plummet. Their gross profit skyrockets. Their net envy surges. To an untrained eye, it looks like an incredible, sudden operational turnaround.
But they didn't improve operations at all. They literally just cleared out the dusty 30-year-old corner of the warehouse to engineer a fake profit surge.
Exactly. LIFO liquidation is a one-time, unsustainable paper gain. It is the absolute definition of low-quality earnings. As an analyst, you have to strip that gain out of your baseline. If you are reading the footnotes and you see a company's LIFO reserve suddenly declining, you know exactly what tracks management left in the snow.
Speaking of stripping things out, let's touch on pro forma, or non-GAAP, earnings, because this practice is rampant in modern financial reporting.
Oh, it is everywhere now.
You open any earnings press release today, and the very first thing you see is a slide deck highlighting a massive, beautiful number called adjusted EBITDA, or core earnings. Management conveniently strips out stock-based compensation, restructuring costs, integration costs, and basically anything else they deem negative noise.
Warren Buffett has a famously brutal line about this exact practice. He asks, if management thinks stock-based compensation isn't an expense, then what exactly is it? A gift. And if it isn't an expense, why does it mysteriously show up on the company's corporate tax return to lower their tax bill?
That's classic Buffett.
It is. As an analyst, you must be hyper-aware and highly skeptical of these non-GAAP presentations. The SEC requires companies to provide a reconciliation table that walks the non-GAAP figure back to the closest, strictly calculated GAAP measure. Your job is to read that reconciliation table line by line, identify exactly what they excluded, and decide for yourself if those expenses are truly one-time, non-recurring items, or if management is just trying to hide the true, ongoing cost of running the business.
Okay, let's unpack that reconciliation workflow for a second, because this is where junior analysts often get totally tripped up. When you pull up a 10K, you don't just look at the headline adjusted EPS that the financial press quotes on television. You scroll all the way down to the reconciliation table. You look at the add backs. Let's say you are reviewing a company and you see a massive add back for impairment of goodwill. Management has added $1 billion back to their earnings, claiming it's a non-cash charge that doesn't matter.
Right. Goodwill impairment is technically a non-cash charge in the current period, so management will loudly argue that it doesn't affect the current operational cash generation of the business. And strictly speaking, they are right about the cash aspect today.
Wait, I've always struggled with this concept. If goodwill is just a made-up plug number that represents the premium they paid over the fair value of an acquisition years ago anyway, why should an equity analyst actually care if they write it down? It doesn't cost them any cash out of pocket today, right? So why not just ignore it like management wants us to?
Because of what a massive goodwill impairment actually represents on a fundamental level, it tells you that management vastly overpaid for a past acquisition. They took shareholder cash years ago, bought a company, and that company failed to produce the expected cash flows. Writing down the goodwill is an admission of terrible capital allocation. It means they destroyed shareholder value.
Exactly. If you just blindly accept their adjusted EPS that conveniently ignores the impairment, you are giving management a free pass on destroying billions in capital. You are ignoring the fact that the historical return on invested capital for this executive team is likely abysmal. You have to hold them accountable for the real cash they spent years ago that simply went up in smoke.
This ties back beautifully to the core concept of financial reporting quality versus earnings quality. They are not the same thing.
Right.
Financial reporting quality is about whether the information is accurate, compliant with GAAP, and transparently presented. Earnings quality is about the underlying economic reality of the business. You can have incredibly high reporting quality, meaning the company perfectly followed all the accounting rules to accurately calculate and disclose a massive goodwill impairment, but very low earnings quality because the business itself is generating poor returns and highly volatile cash flows.
And the reverse is almost never true. You almost never see a situation with low reporting quality, meaning tons of accounting tricks and obfuscation, but high earnings quality.
Exactly.
If the underlying business is truly generating massive, sustainable cash flows and dominating its market, management usually doesn't feel the need to employ aggressive accounting hocus pocus. It is when the organic business starts to stall, when the real cash dries up, that the tricks begin.
Let's explore another area in the footnotes where management can pull massive levers without changing a single operational aspect of the business. Pension assumptions.
Oh, pensions. Those are notoriously complex.
This is a massive area for manipulation, especially for older industrial companies with legacy-defined benefit pension plans. The mathematical value of a massive pension liability and the annual pension expense that hits the income statement are highly sensitive to two tiny assumptions: the discount rate and the expected long-term return on plan assets.
Right. It's just a giant present value math problem. So how does management manipulate it?
It is shockingly easy. If management simply instructs their actuaries to increase their assumption for the expected return on the pension portfolio from 6% to 7%, that tiny 1% tweak immediately lowers their reported pension expense for the year, which directly boosts net income.
Without actually making more money.
Did the underlying economics of the business change? No. Did the portfolio managers actually generate more cash? No. They just changed a spreadsheet input. A savvy analyst will spot that aggressive assumption change in the footnotes, back it out of the model, and normalize the earnings to reflect reality.
Okay, we have covered a massive amount of ground today on this deep dive. Let's tie all of this together with the ultimate litmus test, the one question.
A big one.
When you are sifting through the dense footnotes, adjusting for LIFO liquidations, tracking the ticking timer of the DSO, and trying to figure out if management is leaving tracks in the snow, what is the single most important question you must ask yourself as an analyst?
The one question is cash flow from operations growing in lockstep with net income?
And why does that matter above everything else? What is the final takeaway?
Because management can legally manufacture net income. They can pull forward revenue, they can capitalize expenses, they can tweak pension assumptions, and they can drain cookie jar reserves. But they cannot manufacture the actual physical cash generated by the business. Cash flow from operations is your anchor to economic reality. It strips away the accruals and the assumptions.
If the paper profits are soaring into the stratosphere, but the cash register is empty, you are looking at an illusion. So let's recap the critical takeaways from this deep dive. Number one, financial reporting exists on a continuous spectrum. Conservative accounting builds a margin of safety, recognizing expenses early and delaying revenue. Aggressive accounting borrows heavily from the future, inflating the present at the direct expense of tomorrow.
Number two, you must always read the footnotes for changes in accounting policies and estimates. Management loves to use policy changes to mask operational weakness. Always remember, a change in an accounting estimate is not economic growth.
And number three, always let cash flow be your anchor. Calculate the ratio of cash flow from operations to net income. If it is consistently below 1 or steadily declining over time, the red flags are flying and a reckoning is coming.
As a quick reminder, the strategies and frameworks we discussed today are for educational purposes regarding fundamental financial analysis and do not constitute specific investment advice.
But we do want you to apply this knowledge. Look at the companies in your own coverage universe or the practice vignettes in your current mock exams. Pull up their cash flow statements. Calculate the CFO to net income ratio for your top holdings. Are they converting those beautiful paper profits into real, tangible cash? Or are they just shifting numbers around the spreadsheet? Keep digging and keep analyzing.
Because eventually the weather always turns. The aggressive management teams who assume they could just sprint between the raindrops will eventually get caught in the storm. And the market is unforgiving when the illusion shatters.
And when the storm finally clears, the evidence of what they did is always left behind. Management's choices always leave discernible evidence. But here is a provocative thought to leave you with as we wrap up. For decades, spotting those tracks in the snow required a human analyst to spend countless hours manually digging through hundreds of pages of dense, boring footnotes.
It was exhausting work.
It was. But that era is ending. Right now, massive hedge funds are deploying advanced AI and natural language processing algorithms that can instantly scan the footnotes of thousands of 10Ks in milliseconds.
It's incredible how fast the tech is moving.
These algorithms are trained to detect the exact aggressive accounting anomalies, linguistic shifts, and subtle changes in estimates we discussed today, long before a human analyst has even poured their morning coffee. The game of financial forensics is moving from human intuition to algorithmic detection at light speed.
Which changes the whole landscape.
It really does. The question is, as machines get better at finding the tracks, how will management teams evolve to hide them? That is something to think about until next time. Keep analyzing.